The following extract of balance sheet of PX Limited was obtained. Balance sheet extract as on 31st of March 2021. They given us 20,000, 14% preference shares of rupees 100 each, 20 lakhs. Issued and subscribed capital 15,000, 14% preference shares of rupees 100 each, paid up 15 lakhs, lakh and 20,000 equity shares of rupees 100 each, paid up 96 lakhs. Share suspense account 20 lakhs. Capital reserve 1 lakh and 20,000 is revaluation reserve, lakh and 95,000. Securities premium 50,000. Secured loan 14% debentures 65 lakhs. Unsecured loan public deposit 3 lakhs 70,000. Cash credit from SBI short term 4 lakhs 60,000. Trade payable 3 lakh and 45,000 under current liabilities. Assets investment in shares, debentures, etc. Profit and loss from they are 35 lakhs and 15 lakh and 25,000. Share suspense account represent application money received on shares, the allotment of which is not yet made. You are required to compute the effective capital as per the provisions of section, that is provisions of Schedule 5. Your answer differ if X Limited is an investment company. Yes, it will differ. It will differ if the company is an investment company. Okay. Now, firstly, let us just know what and all will be taken up as part of capital. So we are provided with a balance sheet extract only. It is not a full-fledged complete balance sheet. It is only a portion of the balance sheet that we have taken up. So we understand authorized capital is only the maximum amount of capital the company can issue. That has got nothing to do with the question what they asked as what is the effective capital. So therefore ignore that. We are expected to take up all these capitals, including share suspense and capital reserve entirely we will take up, but lakh and 50,000 is on account of revaluation reserve. Therefore, that cannot be considered. So the entire working can be taken up this way. So we understand 15 lakhs on either case preference share capital. We are expected to take up equity capital. But one thing which I have forgotten to tell you is that the share suspense account is not issued in the form of capital. There is always a chance that it should be refunded also. So therefore, unless allotment is made, we can't be taking the application money as part of our capital there. So I've forgotten to tell you that. Capital reserve, as I told you, to the extent of revaluation, it is representing, it is not backed by cash reserves. So we are expected to deduct security premium as you find that you are expected to take up. Then as part of the effective capital, 15% debentures and public deposits can be taken up. But in the case of when it is a non-investment company, that amount of investments is to be shown as part of the deduction from the capital that you have, and profit and loss account debit balance, of course, has got to be deducted, because in this particular case, they have shown on the asset side as profit and loss account debit balance. Nowadays, as per the new Companies Act, I should not be calling it out as new. So as per 2013, profit and loss account debit balance itself will be shown as part of the reserves and surplus with negative figure. Therefore, it is a old problem that they have just taken it up. It is part and parcel of share capital, whether it is a negative or positive. So when it is not an investment company, we are expected to deduct that so as to find out the effective capital. Whereas when X Limited is an investment company, see where their main objective is to bring about investments there. So that cannot be, or that should not be deducted. And that difference is the basic difference between the two. That is what it is all effectively that is brought out. And therefore, what are the important takes or takings that we have? Authorized capital should be ignored, share suspense should be ignored, revaluation reserve should be ignored. If it were to be an investment company, do not deduct this, whereas in the case of non-investment company, investment in shares and debentures of other entity are expected to be deducted. So our answer will be differing even it is an investment company, and we know as how to make a presentation for effective capital as per provisions of companies. Now, let us just proceed to question number 2. Shweta Limited has the authorized capital of 15 lakhs consisting of 6,000, 6% preference shares of rupees 100 each and 20,000 equity shares of rupees 10 each. And the trial balance they have given. Trial balance running from debit to credit 44 lakhs 72,840 on either side. You are required to prepare profit and loss account for the year ending 31st of March 2018 and the balance sheet as on 31st of March 2018. As per Schedule P of the Companies Act, I will take into account closing stock purchases, salaries and wages. When we just go through as an adjustment, we will go in graded detail. Bills receivable include 4,500, bills receivable of 6,000, depreciation, investment, interest on debentures, provide provision for taxation, technical know-how to the return of salaries and wages include 30,000 towards directors' remuneration, trade receivable 18,000 due for more than 6 months. Now, every item in our trial balance and in the adjustment has got to be taken up. So, investment in shares at cost lakh and 50,000, whether it will appear on the debit side of P&L account or asset side, because all items falling on the debit side should either be coming to the debit of trading profit and loss account or profit and loss account here or on the asset side. So, lakh and 50,000 rupees has got to be taken up on the asset side, purchases to the debit of P&L account. Of course, there is an adjustment to purchases account. Selling expenses has got to be shown on the debit of P&L account. Inventory at the beginning of the period to be taken up as part of debit of P&L account. Salaries and wages on the debit of P&L account. Cash on hand to be shown on the asset side under current assets. Interim preference dividend for the half year ending 30th of September 18,000, which is to be considered as a reduction in their reserves. Then bills receivable on the asset side, interest on bank overdraft on the debit of P&L account. Interest on debentures to be shown on the debit of P&L account. Debtors to be shown on the asset side. Of course, there are some adjustments that we have got to carry out. Trade payables under current assets, and the trade payables should be shown or should be taken up on current liability side. Freehold property at cost. This is to be taken up on the asset side under non-current asset. Furniture at cost less depreciation also as part of non-current assets. 6% preference share capital on the liability side. That's the top item. Equity capital to the same place. 5% debentures, mortgage deposits secured on freehold property. This has got to be taken up under non-current liability. Income tax paid in advance for the current period. This has got to be adjusted against the provision for taxation, and the remaining provision has got to be created. Dividend has got to be deducted from reserves. In this particular case, this is an income. It has to be credited to P&L account. Profit and loss account opening balance has got to be as part of our equity under other equities, and sales figure of 20 lakhs 11,050 on the credit side of profit and loss account. Bank overdraft as part of our current liabilities, and where they have communicated that hypothecation of stocks and receivables being the basis. Technical know-how fees has got to be taken up under non-current asset as part of intangible assets, which has got to be amortized over a period of 10 years is what they given. 18,000 has got to be taken on the debit side of P&L account. These are the items that we have just read out. Now let us just take up closing stock. Closing stock has got to be deducted from opening stock plus purchases, and the net figure of cost of goods sold has got to be taken up, and the same item will be appearing as part of current assets on the asset side. Purchases include 15,000 worth of goods and articles distributed amongst valued customer. This is a sample that they will be distributing on the expectation of good sales to happen. So this is a matter to be deducted from purchases, and the same figure of 15,000 has got to appear in P&L account. Salaries and wages include 6,000 for installation of electrical fittings, which are recorded under furniture. So the 6,000 has got to be both and the same as what we said, as you know, whenever a designer use the visible and increase the amount, and percentage of that 2250 has got to be taken up as deliverable that being they have given you. And that is what we are expected to take up. Now let us just look at revenue from operation, other income, dividend. So these are the two items that you find on the credit side of our this figure and this figure. The rest of the matter we find that they are all liability side items. So in your profit and loss on the credit side, these four items. Okay. Then on the debit side, purchases from which advertisement expenses they have deducted, and from opening stock they have deducted the closing stock, and they have not shown it out as cost of goods sold. Instead, they have shown them separately. So as far as employee benefit expense is concerned, they have not made any adjustment into the P&L account. They have shifted all this to a separate schedule. So salaries and wages, for which item number 9, in which they have just done that. So as per trial balance, 1,56,000 less wages paid for electrical installation, 6,000 taken up, and director's remuneration shown separately. The figure of 1,20,000 rupees they have shown it here. Is that right? So now we will know the purpose for which each schedule was just taken up. Finance cost is a head under which interest on bank overdraft and then interest on debentures, etc. were taken up. So now let us just take up adjustment number 10, interest on bank overdraft and interest on debentures taken up. So people might have this sort of feeling, sir, will I be in a position to do this under examination conditions with so much of schedules and all that? So let me tell you, see, improve your presentation day by day. So you can't be just telling, sir, I would do only the way in which I learned for the first time. So we should only be graduating. Imagine that, sir, I'm just running short of time under examination conditions. Will I be in a position to do all this? If you are not in a position to do nothing wrong, I would say, but even everything when it is going right and presentation on which if they find a problem, we may not be getting full marks. And I'm just only about that. So I would like you people to concentrate on presentation aspect also. In case you run short of time, then I would just say, okay, don't worry, and try as you like. So as far as depreciation and amortization items are concerned, especially on that furniture and fixtures, you have 1,05,000 shown in the trial balance. I will show you. Lakh and 5,000. On to that, 6,000 rupees being incurred for that purpose. We are not conveyed by what point of time, whether full year's depreciation has got to be charged. So let us assume that it was for the full year they are qualifying and charge depreciation on that. And rest of the items, schedule number 11. Payment to auditors, directors' remuneration, selling expenses, technical know-how. In fact, technical know-how rating out can be taken as part of depreciation of the advertisement, bad debts, all that. Shift all this to schedule. And by deducting all these, by taking up all the expenses, it is going to be 19,95,150 and profit before extraordinary income 28,650 and extraordinary income before taxation is 12,000, which is given in the problem itself. And you have profit after taxation of 16,650 and you all know in reserves and surplus they would have adjusted this and deducted towards interim dividend and all that. Let us just go through schedule number 2. So this is the balance surplus for the current period, less preference dividend. That is what they've just given, and the problem 36,000. By doing that, you are just getting up this. I think interim dividend, they have forgotten to show that as part of the schedule. Let me see that. So it is only interim preference dividend only. So 18,000. Yes, 18,000 is included. First half included in the trial balance. The other 18,000 we have deducted. So there is a calculable. Here it is. $66,100. Yes. So that is what you find as part of your reserves and surplus. Long-term borrowings 4,50,000. The debentures, short-term borrowings, state payable, current liabilities. Your liabilities is total. Tangible assets, intangible assets, and non-current investments there. Inventories, trade receivable. This is trade receivable requiring a lot of attention. You have sundry debtors as per the trial balance, and to that more than 6 months breakup. Then other debts and bills receivable, all that together is 2,72,550. Where is that other computation? You have sundry debtors. To that add back bills receivable to the extent of 4,500 for the dishonor and for bad debts, and adjusted sundry debtors, and it is more than 6 months, 18,000. So therefore, 1,34,550. And bills receivable, from there, what you deduct the dishonor portion, it is going to be that. So total comes to 272,550. This is what you see as part of your current asset item, which has got a schedule. Cash and cash equivalents, what they given in the trial balance. And as I told you that income tax prepayment, I mean advance tax payment, if you take it as part of the current asset, it comes to 24,58,950 as the total of the balance sheet, and thereby the requirement of the question is satisfied. What was the requirement in the question? The requirement in the question is that you have asked us to prepare profit and loss account and the balance sheet. As on, there is profit and loss account for the year ending 31st of March and balance sheet as on the date. I hope that all the points related to the preparation of balance sheet is over. And let me just see if there is a note for the purpose of the discounted part of the bills receivable. Yes, there is a contingent liability for bills receivable discount to the bank of 6,000. That is part of the notes to the accounts. That is part of the balance sheet, and notes to the accounts includes the schedule. The following figures have been extracted from the books of Excel for the ending 31/3/2019. You are required to prepare a cash flow statement as per AS3 using indirect method. Net profit before taking into account income tax and income from lawsuits, but after taking into account the following items: rupees 20 lakhs, depreciation, property, plant and equipment 5 lakhs, discount on issue of debentures written off 30,000, interest on debentures 3,50,000, book value of investments 3 lakh, sale of investments rupees 3,20,000, interest received on investments 60,000, compensation received 90,000 by the company in a suit filed. Income tax paid during the period 10,50,000, 10%, 15,000, 10% preference shares of rupees 100 is redeemed by 31/3/19 at a premium of 5%. Further, the company issued 50,000 equity shares of rupees 10 each at a premium of 20% on 2/4/18. Dividend on preference shares were paid at the time of redemption. Dividend paid for the year 17/18 rupees 5 lakhs, and interim dividend of 3 lakh for the year 18/19. Land was purchased on 2/4/18 for 2,40,000, for which the company had issued 20,000 equity shares of rupees 10 each at a premium of 20% to the landholder as consideration. Current assets and liabilities at the beginning and the gain that they have detailed below. Inventory, trade receivable, cash in hand, and trade payables and outstanding expenses 12,000, 2,15,000, 186,300. 2,11,000 in 73,000, 13,18,000, 273,100, 33,300, 211, 300, and 81, 800. See, now let us just go through the problem and find out as what exactly they are expected to do. This is to be done under indirect method. In fact, they don't have to tell that it is to be done under indirect method. By default, we would have just done under indirect method only. For a moment. By default, we would have done only under indirect method. So there is no worry at all as what method we are going to choose, because they have not given us the complete balance sheet and profit and loss account starting from sales until the last item in the balance sheet. So therefore, such problems on which you have got to compulsorily try under indirect method. So here it is net profit before taking into account income tax and income from lawsuits, but after taking into account the following items. So this is net profit before income tax and some extraordinary items, but after doing all this. So to 20 lakhs, the net profit before income tax, but after all these items, depreciation on property, plant and equipment, which is a non-cash item, we have got to add. Discount on issue of debentures written off. This is also they have suffered, but there is no outflow of cash during the current period, so you got to add back. Interest on debentures paid 3,50,000, you got to add back, but it involves cash outflow. But this cash outflow on interest on debentures paid shall be appearing under financing activity and not under operating activity. As you all know that cash flow statement has got to be prepared under 3 activity scale. One is operating, the other one is investing, the other one is financing. When you have these 3 heads, this indirect method is applicable only for operating activity. For financing and investing, direct method and indirect method are going to be same. Then book value of investments 3 lakhs, sale value of investment 3,20,000. See, they wanted to communicate that after taking into account, this is a profit. That means there is a profit to the extent of 20,000 included in 20 lakhs. We are expected to deduct, even though it involves inflow of cash, but we are deducting on account of what? On account of this item should come under investing activity and it is shown under operating activity. Interest received on investments of 60,000 is included in 20 lakh. That has got to be deducted here. The same has got to be shown under what? Investing activity. Then compensation received 90,000 by the company in a suit filed case. This is an extraordinary item which has got to be shown separately. Income tax paid, that being 10 lakh and 50,000. Only 10 lakh and 50,000 has got to be deducted from the income from operations. Then 15,000, 10% preference shares of rupees 100 each were redeemed on 31/3/19 at a premium of 5%. Further, the company issued 50,000 equity shares of rupees 10 each at a premium of 20%. See, all these we have got to be very careful with. 15,000, 10% preference shares redeemed will come under financing activity, and that put a premium of 5%. Further, the company issued 50,000 equity shares of rupees 10 each at a premium of 20. This will come under financing activity. This one will result in outflow. The second one will result in inflow. Am I right? This
Yes,
is
sir.
on 2/4/18. Dividend on preference shares were paid at the time of redemption. So dividend will also be considered as part of the outflow under financing activity. Dividend paid for 17/18 rupees 5 lakhs during the current period. That will come under financing activity. Interim dividend paid of 3 lakhs for year 18/19. That will also be coming under financing activity. So item number 5 will not be coming up at all because this land was purchased for 2,40,000, for which they have issued equity shares, and it will not come under Financing activity nor under investing activity. So this transaction is a non-cash transaction and we have to simply ignore. But we are expected to disclose this matter elsewhere. I will tell you where. Current assets and current liabilities, changes in inventories. So if there is an increase in inventory, then it results in outflow of cash. Trade receivable, when there is a fall in the trade receivable, there is an inflow of cash. So this should be the starting point, opening cash and cash equivalent, and this is the closing one. The difference between the two is decrease in cash and cash equivalents, for which you have all that. Trade payable, there is an increase in trade payable by 300, whether it is marginal sum or a substantial sum, it has to be given the proper care, which is an inflow of cash. Outstanding expenses, inflow of cash. So with that, all the items we have discussed, now let us just see as how the discussion is exhibited in the form of a cash flow statement. See, as I told you, those items which we normally would have debited to profit and loss account, we have to add back. And those items which we normally credit to profit and loss account will be deducting. You just see depreciation, discount, and interest on debentures paid, which are all debited in P&L account. We are adding it back, and interest on investment and profit on sale of investment, which we have credited to P&L account, we have deducted. Operating profit before taking into account working capital changes. The last item that we have seen, those changes in working capital items, we have taken up outflow within brackets and inflows without brackets. Total it is 1,06,000. Cash generated from operations 26,94,000 with income tax payment of 10,50,000. All these items are to be taken up as before taking into account abnormal items. And in the case of compensation, what they received is an extraordinary item, which is to be shown separately. And therefore, 17,34,000 is the cash flow from operating activity. But let me tell you, my way of explanation is very easy, but your way of working will take time. So therefore, you should not feel that I am just running on to the solution directly. Yes, because I need to explain, I'm just doing it. Whereas you want to work out, is going to take time for you. So cash flow from investing activity or sale of investments and interest received on investments, both are inflow without brackets shown there, and the cash flow from financing activity, issue of equity capital without, and redemption, preference dividend, interest payment, and the dividend of the 2 years, all that resulting in outflow, and which results in the net figure of 22,70,000, which results in net decrease in cash and cash equivalents to the extent of 1,61,000 upon adding it with the opening balance. You get into the closing balance. As I told you, your disclosure has got to be made as part of a cash flow statement, the non-cash transaction, which involved issue of capital or purchase of land. That has got to be taken up. With that, solution to question number 3 is getting over. Question number 4, that Omega company offers a new shares of ₹100 each at 25% premium to existing shareholders on a basis of 1 for 5 shares held. 1 for 5 shares. The market right is ₹200. So you are required to calculate X rights value of a share and value of right shares. So what is this actually? So solution to question number 4. So we have something called as theoretical X rights price. Theoretical X rights price equal to M into N plus R into S divided by N plus R, where M stands for market price per share prior to rates. Prior to rates. N stands for number of equity shares before rates or qualifying for rates. R stands for rights shares. S stands for subscription price of rights shares. So always remember the subscription price will always be less than M. This is a fact. It can't be equal to M even. Don't ask me a question whether S will be greater than M. So nobody would like to buy a share at a price greater than the price quoted in the market. So therefore it can't be greater. And nobody would like to subscribe for the same market price to the company. If they got to subscribe, they can buy as well in the open market at market price itself. Why would then they would like to subscribe? So always in rights issue, the rights issue price will always be lower than the existing market price. That you have to remember. Now, what they mentioned, there is a small problem where I just don't want to go by PDF. So this is 200 into the number of rights which will qualify for one right is 5. 20 into 5 plus R1 into subscription price of 25% premium to the on the basis. So it is 125. How come 125? 100 rupees each, 25% premium is what they have given. The whole divided by 5 plus 1. So it is 1125 divided by 6. 1125 divided by 6 would mean this 187.5. What is the first question that they asked? X rights value of a share. This is not X rights value. This is theoretical X rights price. Then maybe theoretical X rights price or X rights value. Both are indicative of the same thing. What is value of our rights? So this is answer to the first part of the question. Second one. So value of a right is equal to N into. I am giving you the formula and I will also tell you the logic. Value of right is equal to N into M minus X. This is X. Theoretical X rights price is X. That being 5 into 200 minus 187.5. So how much it comes to? 200 minus 187.5 into 5. That comes to 62.5. Or there is one more formula that you have. That being X minus subscription price. X is 187.5 and the subscription price is 125. So how much is that? That comes to 62.5. I'll tell you the logic. Logic is a very simple logic only. What is that? So the existing shareholder who is not in a position to subscribe for the capital of the company can sell his rights. The person to whom he is effecting a sale, he will be charging him to be 62.5. Why 62.5? The value per share prior to rights issue was 200. Soon after the rights issue, it is coming down to 187.5. He is losing for every share 12 rupees and 50 paisa. And 5 shares, existing shares will make one right. So it is 5 into 12.5, which is 62.5, is the one that you have, right? Or if you tell this logic that you are losing so much and all that, the other person may not understand. So you understand in the form in which he is understanding it, that is, he could feel it. So theoretical X rights price is 187.5 because he subscribes only 125 rupees, whereas soon after subscription, the price is going up by 187.5. Ask him from where he is getting the gain. And you tell him that point that 62.5, what he gains is a loss that you have suffered. And therefore, he will have the mind to pay you. Or tell him beforehand that the value of a right is going to be 62 rupees and 50 paisa. So now you just find what they have given is not correct. But they say some right value of a share is not 12 rupees and 50 paisa. 12 rupees and 50 paisa per share only. But value of a right is not 12 rupees and 50 paisa. It is 62 rupees and 50 paisa. They committed the mistake. That is the reason as why I thought I will explain it, and I'm not. No, I'm happy with the presentation what they made. This is not 12 rupees and 50 paisa. This is per share they lose, but 5 shares will make one right. Okay. Question number 5. The following is a summarized balance sheet of Bum Limited. As on 31st of March 19, they are giving you equity shares 50,000, 5 lakhs, and 10,000 preference shares 10 lakhs. Total is 15 lakhs. Issued, subscribed, and paid up 30,000 equity shares of rupees 10 each 3 lakhs. 5,000 8% redeemable preference shares 5 lakhs. Security premium 6 lakhs. General reserve 6 lakhs 50,000. Profit and loss account 40,000. Trade payable 4 lakh 20. And all that comes to 25 lakhs 10,000. Application of funds PPE. Net means after depreciation 7 lakh 80,000. Investment market value 5 lakh and 80,000 within brackets. 4 lakh 90,000 is the balance sheet value. Deferred tax asset 3 lakh 40. Trade receivable 6 lakhs 20,000. Cash in bank 2 lakh and 80,000. Balance sheet total 25 lakhs 10,000. In AGM on 20th of June 19, the company passed the following resolution to split equity shares of rupees 10 each into 5 equity shares of rupees 10, 2 each from 1st of July. To redeem 8% preference shares at a premium of 5%. To issue fully paid bonus shares in the ratio of 1 equity shares for 3 held on record date. So splitting the share, 10 rupees share would mean now 2 rupees when you make, you have to increase the quantity by 5. And redemption of preference shares, what they have mentioned is this 5 lakhs of rupees preference share capital has got to be repaid and 5% premium. So 5 lakhs and 25,000 will be the cash outflow. And we all know that redemption of preference shares can be carried out only for fully paid preference shares that can be paid out of profits and otherwise available for declaration of dividend or out of fresh issue of capital. In this problem, they have adequate amount of resources in general reserve to carry out this redemption, and from this general reserve we can have it transferred to capital redemption reserve, and from there bonus shares can be declared. So 1 for every 3 shares held. That means after the splitting of shares, you got to go about on this and to find a liquidity to settle for redemption of preference shares. They are selling investments for rupees 5 lakh and 55,000 and 5 lakh and 55,000 is the sale price, and cost price is 4 lakh and 90,000. So thereby there will be a profit to the extent of 65,000. Am I right? 65,000. That is going to increase your existing profit and loss account balance, and that will not cause any worry for the creation of capital redemption reserve. And bonus issue was concluded on 12th of September. You are required to journalize and including cash transaction and prepare a balance sheet, and all working notes should form part of the answer. So the balance sheet is provided on 31st of March 19. They had no other business excepting this, and we can incorporate all this transaction and take up to the next stage. So now let us just find out as to how splitting of shares can be taken up. Equity capital, which remained at rupees 3 lakhs previously, will continue to be there at rupees 3 lakhs upon splitting. The thing is that instead of 30,000 into 3, it is going to be lakh and 50,000 into 2. Okay. Then, as far as sale of investment is concerned, cash and bank balance debit, credit, investments credit P&L account 65,000, being investment sold out and profit on sale credited to profit and loss account. That is the way we are expected to complete that. Then 8% preference share capital 5 lakh and 25,000 towards premium on redemption. You get preference shareholders claim the extent of 5 lakh and 25,000, and they were debited and cash was paid because they had the liquidity, they have paid that. So from general reserve, they have to create capital redemption reserve to the extent of 5 lakhs. That premium on redemption has got to be knocked off from security premium and For the purpose of bonus shares, one for every 3 held is what we just seen there. And the share capital was 3 lakhs. One for every 3 held would mean 1 lakh of rupees from capital redemption reserve. You have to take it up. And securities premium was used for that purpose. And absolutely, there is no other change that you would be expecting there. And now the share capital is expected to be the 3 lakhs, lakh and 50,000 into 2. Now it is going to be 50,000 into 2, both put together, it is going to be 4 lakhs. Reserves and surplus for which 12 lakh and 30,000, for which you have the adjustment like securities premium 6 lakhs, against which you have premium on redemption of 25,000 getting deducted. Capital redemption reserve was created for 5 lakhs, 1 lakh for which bonus was issued, and general reserve from 6 lakhs and 50,000 for CRR. You have taken up profit and loss account, what you had to which profit on sale of investment of 65,000 when you take it up. So these two together will be 6 lakhs 80, and with authorized capital will be ignored, and by taking into account 4 lakhs for equity capital, you will have 4 lakhs, and 5 lakhs and lakh and 5,000 will bring about the equity to, sorry, reserves and surplus to 12 lakh and 30,000, because we had some more balance also there. Let me just check it up. Yes. So all that we have just seen, it comes to 12 lakhs and 30,000. And trade payable as the only item which never underwent a change between the last balance sheet to the current balance sheet. PPE, no change. Deferred taxation, no change. Trade receivable, no change. But cash and cash equivalents, yes, we had a change. And I think so. They have just given a separate working for that, and it is 2,80,000 as per balance sheet realization, and what they will do preference shareholders, which resulted in 3,90,000. So, which resulted in the preparation of balance sheet is